Hi guys, welcome to accounting for October the 12th. We're going to be doing a new problem today. It's problem 1-2A. But before we get started, I want to look at our module just as an overview. And I'm going to go back here to the previous day. On October the 8th, I put some information in your module. When you are beginning a problem, don't just go to your to-do list. Come to the module for the day and look at the information that is here for you, because I put instructions in on how to do the problems, and if you don't look at that first, if you just go to try and do your homework, you're going to be stuck, because you won't be able, if you don't follow the instructions, you won't be able to do the problem, or it will be a lot harder than it would be otherwise. So anyway, this is the last assignment that I gave, and I gave you problem 1-1 as a problem. And here are instructions to do that problem. So please make sure that you are looking at that. For one thing, it was an assignment, but for another, it's valuable information that will help you. So it's there for your help. Also, you have a title here called Joining the Pieces, and it has some very good reference information here for what we have been doing in the last few days. In particular, I want to look at summarizing the transactions, because this is very similar to the problem that you're going to be doing today. And this is from your textbook, but I just copied a page so you could have it just to be able to look at it quickly. But this is an expanded transaction version of a list of transactions, very similar to the ones that you did on October the 8th and the ones that you're going to be doing today. So let's look at these. It's listed as the accounting equation. And remember, our accounting equation is assets equals liabilities plus owner's equity. And remember, everything you do on one side of the equal, you have to do on the other side, because you have to keep your problem in balance, just like an algebra problem. So also on the assets, in this problem, you have 4 assets. You have cash, accounts receivable, supplies, and equipment. And they are all assets because they have value and they are owned by the company. Liabilities, you have accounts payable is your only liability. And remember, a liability is a debt. It's something that you owe. And then you have owner's equity. You have the owner's capital account. You also have a revenue account or income that adds into capital that will increase it. And then you have expenses that will decrease capital because they are spent for the business. Okay? So let's look at these transactions. In your problem, you're going to have a list of transactions, and you are going to classify them according to what the transaction tells you. In the beginning here, for example, transaction A is an investment. So you're going to increase cash and you will increase capital. Notice you're on either side of the equal sign, because here's the equal sign. So you will do, if you increase one side, you increase the other. That's an investment, so it's increasing cash and it's increasing the owner's capital account. The second transaction was an equipment purchase, and it doesn't say that it was for cash, so this is on account. You increased equipment, and you also increased the debt. You increased accounts payable because you have to pay for the equipment later. Now after this one, you will do a balance. And you see, if you add these two, adds up to $50,000. equals, and then if you add these two, it's 50,000. So you always have to keep the transaction in balance. The accounting equation must stay in balance after every transaction. Now notice the supplies purchase. It takes place on one side of the equal sign. It doesn't cross the equal sign because you spent an asset or you spent cash, so minus $2,000, and then you bought supplies. So you increase supplies for the same amount. The equation still stays in balance, and you have two entries for the transaction. You will always have at least two entries for every transaction because every transaction affects at least two accounts. Now, transaction D are legal fees. So they received cash for legal fees. So you increase revenue because she is an attorney and that was her income, and then you increase cash because they paid cash. The next one, and again, you're balancing after every transaction. The next one is they paid salaries. So you decrease cash because you have paid salaries, and then you are increasing your expenses. Now notice that this is a plus, but up here this is a minus. So this rules. You're going to subtract the expense, but you just increase your expenses so you can have a record of how many expenses you will have. So anyway, that is what this is.
Any student who did not have their picture made this morning for the yearbook.
And after that, you will just go on each transaction, paid on account. See, you paid on your equipment that you bought in transaction B. You paid $5,000. So you decrease cash, you decrease accounts payable. On the owner made a withdrawal in G, so you decrease cash, and you decrease her capital account because she took money out of the business. For legal fees, she earned $2,600 for legal fees, so you increase revenue, and you also increase cash because she received cash for her services. And notice it's on either side of the equal sign, and you've done two entries. Utilities expense and rent expense, you show them separately, but you've decreased cash because you paid utilities and you also paid rent. But you're increasing your expenses, but again, you're going to subtract that in the equation. Legal fees, this one, she earned legal fees or income. She increased her revenue, and she increased accounts receivable. That means she didn't receive cash this time, but her client will pay her at a later date. And then finally, you have received on account. From this transaction, you increased cash $300, and you decreased your accounts receivable because they paid on their account. So you decrease their account. Again, this is the same side of the equal sign, so it offsets because you have an increase and a decrease, but it equals out. And again, if you look at the bottom here, you always want to proof your account once you're finished. The assets are $45,950, and then if you add up your liabilities and your equity accounts, they add up to the same thing. So you always want to make sure that you are in balance at the end. So now let's go on to our assignment for today. Okay, our assignment for today you will find under October the 12th. And again, if you want some information, go back to the day before. There's all kinds of information here. These are videos to watch, and also these are reference sheets like the one we just looked at. that will be a good reference item if you have a question. So what you're going to be doing today is you're going to go to problem 1-2A. And it is on a Google Sheet, and what you will do is you're going to use this form here. Now, if you just bring up the form, you cannot write on it. What you have to do is you have to go to File, Make a Copy, and then it will say Copy of Problem 1-2A, and say OK. You will make a copy, and then you will be able to write on the form. So let's go back and look at our problem. And here are the transactions that you are going to be putting on your form that you just copied. And they will be listed. You'll do it by transaction number. So for example, Philip invested $10,000 cash in the firm. Now he opened a shoe repair business on April the 1st. So during April, here are his transactions. So the first one is he invested $10,000 cash in the firm. Let's go back to open our problem 1. Now remember, this is copy of problem 1-2A. So if he is put $10,000 in, it's plus 10,000, and then you will increase his capital account, $10,000. And after every transaction, you are going to balance it. So there will be $10,000 in cash, and the capital account will have a balance of $10,000. Now the reason that I put it on either side of the equal sign, see, I increased here, and I also increased cash. So I'm on either side of the equal sign here, and I stay in balance. My assets for this problem are cash, accounts receivable, office supplies, and equipment. The other accounts you'll use, you will have a liability account of accounts payable, and remember that's a debt. You will have your capital account, Philip Cedar Capital, and you have revenue and expenses. And you have to remember that after every transaction, you keep your account in balance. And what you do to one side of the account, you do to the other side, unless, for example, you pay cash for supplies or something like that, and as long that will be a plus and a minus offsetting on one side, but the account will still stay in balance, or the transaction. Also, something I wanted to point out to you, you have accounts receivable in assets, you have accounts payable in liabilities. Remember the difference between those. Accounts receivable is an amount that you will receive in the future. Someone has, you've done business with someone and they will owe you money in the future. So you're going to be receiving this money. Accounts payable is a debt. You have bought something on account and you're going to pay for it in the future. So this is something you are going to pay. It's a payable. It's a debt. So, and again, make sure you make a copy of this problem, because if you don't make a copy, you won't be able to write on this form. So I'm going to go back here, and this is your problem for the day. 1-2A. And remember, you're going to put it in an expanded accounting equation like we just looked. And the first thing you will do is you will go to problem 1-2A and make a copy of the document. Then you will put the transactions in an expanded account form, and you will put a balance after every one. And as always, if you have questions, please let me know. Thank you.